Sure. Thank you, Ajit, for the presentation. We'll now take up the questions which have come from the members of the audience. Let's begin with this question where we really want to dig in with the amount of experience you have. You travel across the world and meet foreign investors looking to invest in emerging markets like India. What's the sense that you are getting from them, especially investors who are serious long-term kind? Are they worried about drought in India, politics in India, or India's rising fiscal deficit?
I think that the way I think that long-term capital understands the long-term economic, policy-making structures in India. What they get very concerned about is not the deficits, because there are higher deficits in many developed countries these days than in developing countries like India. Their concern really is what is the policy-making framework which allows long-term capital to invest in India, and how much of noise is there in the Indian capital markets. So the concern is not that much on the fiscal deficits. It's not that much on, how will the global economy impact India, because many of them truly believe that India is relatively de-linked from the global economy. But they are very concerned is, does the government understand that this kind of money exists? Does the government have a framework to accept this long-term money? I must sort of, warn you in many ways or flag that I don't meet hedge fund managers, I don't meet short-term capital. So I can't, so whenever I speak or give an answer, it's really from a long-term capital perspective.
Fair enough. You talked about the mess that the government has created, and what's your view? How does the government get out of this mess? And as some members have asked, is it the right time to discount the secular risk and try to move money across geographies rather than staying invested only in India?
Depends on, I think that you should always have a portfolio based upon what your cash flow needs are for the future. If you don't have any need for US dollar or Japanese yen or British pound, I would be reluctant to recommend that people move assets to those currencies, because then you have a currency play going on. And I don't think you should play currencies. You should earn in the currency in which you wish to spend. So if you're spending in rupees, earn in rupees. If your spending is in rupees, you don't want to start allocating to pound and US dollar and Japanese yen, which means you're crossing borders and taking an extra risk on currency. I mean, Indian multinationals in the 1970s, when they could not, Indian companies in the 1970s, when they could not grow in India because of the Monopoly Restrictive Trade Practices Act and the licensing Raj, they moved over to places like Southeast Asia. And I'm talking about the Tatas and the Birlas and the Goenkas and the Singhanis and some very, smart, intelligent industrial people. And they went there, and many of their companies, if not most of them, got wiped out because those currencies, those economies and currencies went through huge devaluations, between 1980 and the mid-1990s. And, so I mean, it's the same thing. Their profitability in India was hurt by some, play that they had on currencies. And why go far? Why go so far back? Last year, Indian companies took huge write-offs in their quarterly profits for the year and for the period ending December 2008, because again they were doing all these financial derivatives and gambling in dollars and gambling in yen. I don't know what they were doing. So never have that mismatch. The minute you mismatch, it may work for you, it may not work for you. So why have that uncertainty in life? So stay on in India. If you have family members, you have children who wish to one day go and study in the US, or you wish to send them there, fair enough. You can start sending dollars overseas slowly, and you're allowed to legally do that and buy some dollar assets and build up a reserve so that when your child is 21 years old, you've matched a dollar wealth for a dollar expenditure that your child may spend when they have to pay tuition fees, which are very expensive in US of A.
Well, staying on with the asset allocation, is there a right formula to decide what kind of, how does one go about allocating assets between stocks, mutual funds, bonds, gold, property? This is one question which a lot of people have asked actually.
Well, strangely enough, if you go on to slide number 16, of the PowerPoint, I'm actually about to start something called a Path to Profit tour. I plan to drive across many cities in India, starting tomorrow actually, and I'll be on the road for some time and come back to Bombay, then head out on the road again. But this Path to Profit really shows a portfolio that we sort of recommended or had built going back in history to see if you had asset allocated correctly or sensibly, not even correctly, just sensibly, you would have had a better return over a cycle of a boom market and a bear sort of stock market. And you'd have had a lot more sleep. You'd have lost a lot less sleep. So yes, asset allocation is very important. In the quantum mutual funds, there's a website called quantumequitydirect.com. There's an asset allocation tables, over there, and you should certainly see that. But I will be writing more about this in the Path to Profit over the next couple of weeks.